Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us again. Don't forget to like and subscribe. Click the bell so you get a notification of when we're releasing a new video. I'm sitting today with Nick Rogers, Portfolio Manager at Harvard House. Hello, Nick.
Morning, Robert. How are you?
Yeah, good, thanks. Nick, we have touched on China a little bit, but I know that you've been digging quite deeply into China, and it's kind of this economy on the side, which is really a big engine for South Africa. So maybe give us some insights that you think are relevant in terms of what's happening in China and what we should be knowing about.
Sure. So I think to start off with, the global growth has been under pressure. Post-COVID, interest rates have risen. Inflation's been high, so it's all a global growth story, and everyone's been waiting for the Fed to cut rates, which they did, as you know, in September by 50 basis points. That then gave China the cue to cut their rates, so that everyone's been waiting. South Africa followed suit as well. So they cut by 50 basis points as well, but they also announced big monetary stimulus, and that 50 basis point cut it frees up 150 billion in disposable income. So the Chinese haven't been spending. The property's been under pressure. 70 to 80% of their wealth is tied into their own property. So the confidence has been down, and the government has been trying to find ways to stimulate that property. And on top of that, they announced a 800 billion yen stimulus, which allows share buybacks. It allows people to trade through stockbrokers, registered stockbrokers, big institutions, to give an underpin to the share market. Because if the property market isn't recovering as quickly as they need it to, even though they've dropped the rates, if you get the share market going, then they might dip into their wealth. And that did happen, and that's why the shares did rally. Stimulus plus the wealth effect, a bit of positive sentiment.
Yes.
That's fed through.
Yeah. And I mean, I think we're certainly feeling the wealth effect in South Africa a little bit as share portfolios go up.
Yeah, correct.
Nick, this concept, I think everyone looks at America and it's NVIDIA and, everything going on there, AI. But China's not behind in this stream either, are they?
No, not at all. In fact, the new policy in China is very much aimed at technology and growth in the new economy. So they've built cities for the last 20 years. They've been building cities. There's that age-old fact of in 3 years that they used more cement. That's the 2011 to 2013 than America did in the whole 20th century.
Sure. So
they've gone through that phase of setting up the infrastructure. And the next stage, all the policy is now aimed at the green technology. So it's electric vehicles.
Yes.
And you've seen the numbers come through. You've seen Germany react to these cheap Chinese EVs, which are, I think superior. BMW, Mercedes, all those companies are taking strain. But in the tech shares, you've had the likes of Alibaba just languishing out of love. All the money in the last couple of years has rushed into the US tech, and you've seen that in the US ETFs and the FANGs, Microsoft's, Facebook, Meta's, all those companies have hit record highs. But China's been forgotten. And Alibaba, for instance, you can compare it to an Amazon, and it's got a big cloud side to it, similar to Amazon. But it's the third largest cloud player in the world. It's a lot smaller than Amazon and the US companies. But in terms of its exposure to Southeast Asia and China, you've got a large portion of the world's population there. So they've got huge potential to tap that market. And at the same time, they're in 190 countries around the world, so they are expanding globally. We haven't got Alibaba in portfolios, but Tencent and Naspers and Prosus are the players that we've used. That's the Chinese gaming, and they've shot up in line with the Chinese market.
Yes.
So the tech shares are definitely in vogue. That's where the world's heading. And then because tech shares need data centers and storage, copper's the play, which we've talked about before. So the potential recovery through all this Chinese stimulus is not going to go back into the old iron ore story, the old commodities.
Yeah.
They'll still be in demand, but the consumption of copper, rhodium, platinum, palladium, all those type of metals that play into the new technology. Yeah. That's where the demand's going to come from.
And to some extent, we've seen that in the platinum and palladium prices, squeaking over $1,000 an ounce finally, isn't it? So, I mean, that has made a big difference.
It's made a difference. I think what's happened, the Chinese EV, electric vehicles, they've done extremely well in China, but Europe, America are languishing. We've mentioned before that the hybrid, where you've got an internal combustion motor plus EV, combined is actually the preferred use, which hasn't been expected. It was all going EV.
Yes.
So you will see platinum, palladium, rhodium pick up as the combustion engine doesn't fade away quickly. It's still in the picture very much.
Okay, so the internal combustion engine is dead. Long live the internal combustion engine. Nick, thanks so much for giving us that insight into China. We appreciate your time.
Absolutely.
Thank you for joining us. Don't forget to like and subscribe, and we'll catch you next time. Bye-bye.